When it comes to building long-term wealth, two strategies dominate the conversation for everyday investors: putting your money into index funds or investing in real estate. Both have genuine merit. Both have real drawbacks, and the honest truth is that neither one is universally better than the other. What works depends entirely on your situation, your temperament, and what you're actually willing to do day after day for the next 20 or 30 years. Let's start with the basics. An index fund is a collection of stocks bundled together to track a market index, like the S&P 500. When you buy an index fund, you own a tiny slice of 500 large companies. Real estate investing means buying property, a house, an apartment building, vacant land, with the intention of either renting it out for income or selling it later for a profit, or ideally both. The historical returns of the stock market, including index funds, have averaged around 10% per year over the last 100 years. That number includes all the crashes, all the bear markets, all the years when everything fell apart. It's not a guarantee, but it's a real historical baseline. Real estate, depending on where you buy and when you buy it, has historically appreciated somewhere between 3 and 5% per year on average, though some markets have done much better and others much worse. If you factor in rental income, real estate investors often see total returns in the range of 8 to 12% annually, but again, this varies dramatically by location and property type. So on paper, index funds have a slight edge in pure return potential. But paper doesn't tell the whole story. Let's talk about what it actually takes to succeed with index funds. You need to open a brokerage account, which takes maybe 30 minutes online. You need to choose a fund or a handful of funds. You need to set up automatic monthly deposits if you can. And then you need to do absolutely nothing else. You check it maybe once or twice a year. You don't panic when the market drops 30% because you understand that you're in it for decades and crashes are normal. That's genuinely all it takes. The barrier to entry is almost nothing. You can start with $50. The time commitment is minimal. The emotional labor is manageable if you have the right mindset. Real estate is different, much different. First, there's the capital requirement. Most lenders want at least 20% down on an investment property. If you're buying a $300,000 house, that's $60,000 in cash you need to have sitting around. Index funds, you can start with your next paycheck. Real estate demands capital upfront in a way that stocks simply don't. Then there's the process of actually buying. You need to find a property in a market you understand. You need to have it inspected. You need to negotiate. You need to deal with appraisals and loan officers and title companies. You need to understand local zoning laws. You need to think about whether the neighborhood is appreciating or declining. This takes weeks or months. It takes energy. It takes knowledge that you might not have. Once you own the property, the real work begins. If you're renting it out, you're now a landlord. Tenants break things, pipes burst, roofs leak, furnaces fail, and every single one of these problems is your responsibility and your expense. You can hire a property manager to handle it for you, but that costs between 8 and 12% of your rental income. That's a massive drag on returns that most people don't factor in when they're dreaming about their real estate empire. If you self-manage, you're taking phone calls at 10 p.m. about a leaky faucet. You're showing the property to potential tenants. You're evicting people who won't pay. You're coordinating with plumbers and electricians and roofers. This is not passive income. This is a small business that you're running, and small businesses demand your time. Then there are the costs that accumulate invisibly: property taxes, insurance, maintenance reserves, vacancy periods where you're not collecting rent but the mortgage is still due, HOA fees if you buy in a managed community, capital gains taxes when you eventually sell, closing costs when you buy, which can be 3 to 5% of the purchase price right off the top. These costs exist for index funds too, but they're much smaller. You pay maybe 0.03% in annual expense ratios, and then capital gains taxes only when you sell, which you might not do for decades. With real estate, the costs are perpetual, and they're significant. Let's walk through a realistic long-term comparison. Imagine two investors, both starting at age 35, with $80,000 to invest. Both plan to let their money sit until they're 65, 30 years of compounding. Investor A puts the $80,000 into an index fund portfolio. She sets up automatic monthly contributions of $500. She experiences the 2008 financial crisis, where her portfolio drops 40% in value. She stays the course. She experiences the pandemic crash in 2020, where stocks fall 30% in weeks. She stays the course. At age 65, assuming a 10% annual return, her account is worth approximately $4.2 million. That's with no active effort after the initial setup, no late-night tenant calls, no capital calls for emergency repairs, no expertise required. Investor B buys a $300,000 rental property with his $80,000 down payment. He gets a conventional loan for the remaining $220,000. His monthly mortgage payment is roughly $1,400. Property taxes, insurance, and maintenance reserves add another $400 per month. He rents the property out for $1,900 per month, so his cash flow is positive, but only barely. He's making about $100 per month before accounting for vacancy. When something breaks, and in a 30-year period many things break, he pays out of pocket or he eats into his cash flow. He manages the property himself to save money. Over 30 years, assuming the property appreciates at 4% annually and he never raises rent, the property is worth roughly $790,000. He's collected roughly $140,000 in net rental income over 30 years, accounting for vacancies and maintenance. So his total wealth from this property is roughly $930,000. Investor A has $4.2 million. Investor B has $930,000. That's a difference of more than $3 million, and Investor B worked significantly harder for it. Investor B still has his $80,000. Maybe he's reinvested some of his rental income. Maybe he's bought a second property. The comparison gets complicated, but even if Investor B was more aggressive and built a portfolio of 3 properties, he'd still likely be behind Investor A because the index fund growth is so mathematically powerful. And Investor B would be managing 3 properties while Investor A is living her life. However, this isn't the complete picture either, because real estate has advantages that pure returns don't capture. First, leverage. When you buy a property with a mortgage, you're borrowing money from the bank to amplify your returns. You put down $80,000 and control $300,000 in assets. If that property appreciates by 10%, you've made $30,000 on your $80,000 investment, which is a 37% return on your capital. Index funds don't offer this leverage. You can use margin accounts, but that's riskier, and most people shouldn't do it. Second, control. When you own real estate, you control it. You can make improvements that increase the value. You can refinance if rates drop. You can change the tenant mix or the rental strategy. With index funds, you're a passive owner. You have no control. For some people, that's perfect. For others, that's frustrating. Third, tax advantages. Real estate investors can deduct mortgage interest, property taxes, maintenance, depreciation, and various other expenses. These deductions can be substantial. Index funds held in taxable accounts generate capital gains that you have to pay taxes on. If you hold them in retirement accounts like a 401k or an IRA, you avoid taxes, but your access to the money is limited until retirement. Real estate offers more flexible tax treatment. Fourth, inflation protection. Real estate is a tangible asset. If inflation accelerates, you can typically raise rents in response. With index funds, you own companies that may or may not be able to pass inflation on to their customers. Real estate provides a more direct hedge against inflation. Fifth, and this matters more than people admit, real estate investing teaches you valuable skills. You learn about markets. You learn about construction and property management. You learn to evaluate risk. You learn to negotiate. These skills have value beyond the investment itself. But here's the critical difference that most real estate enthusiasts don't want to acknowledge: liquidity. If you need your money back, index funds can be sold in minutes. You can access your cash the next business day. Real estate takes months to sell. You need to list it, show it, negotiate with buyers, deal with inspections and appraisals, wait for their financing to close. If you're in a bad market or the property is in poor condition, it could take a year or more to sell. And when you do sell, you lose 3 to 6% to real estate commissions and closing costs. If a true emergency happens, a health crisis, a job loss, an unexpected opportunity, liquid index funds give you options. Real estate traps your capital. Then there's the principle of diversification. When you buy a single rental property, you've concentrated significant capital in one asset, in one location, in one market. If that neighborhood declines, if the property requires major repairs, if you can't find tenants, you're stuck. With index funds, you own hundreds or thousands of companies across dozens of industries and countries. That diversification reduces risk substantially. So which strategy should you choose? Index funds are better if you want simplicity, if you want genuine passive income, if you want diversification, if you want liquidity, if you have limited capital, or if you don't want to manage a business. They're also better if you have limited time, or if you simply don't enjoy the work that real estate demands. Real estate is better if you have significant capital available, if you enjoy the work, if you want leverage and control, if you want to use depreciation and other tax benefits, if you value tangible assets, or if you believe strongly in a specific market or property. Real estate is also better if you can add value through improvements, or if you have skills in property management or construction. The honest answer is that many successful investors do both. They build a solid foundation with index funds because the returns are good and the work is minimal. Then, if they have capital and interest, they add real estate as a way to leverage their money and potentially achieve higher returns, acknowledging that they'll be working harder for those returns. What matters most is that you pick one and commit to it. The worst outcome is bouncing between strategies, never giving either one enough time to compound. Time is the greatest advantage you have. Whether you're in index funds or real estate, 10 years is merely adequate, 20 years is powerful, and 30 years is transformational. The specific asset class matters less than the discipline of staying invested and the patience to let compound growth work. So choose based on your actual life, not on what sounds impressive at a dinner party. Choose based on what you'll actually do, not on what you wish you'd do, and then commit to it for decades. That's how real wealth gets built, regardless of whether it's in a brokerage account or a rental property.